Definition of banking. Section 5B of the Indian Regulation Act 1949 defines banking as accepting for the purpose of lending or investment of deposits of money received from the public, repayable on demand or otherwise, and withdrawable by check, draft, order, or otherwise. In the layman language, bank functions to accept the deposit and lend the loans to the common man, which can be repayable on demand or otherwise, which can be withdrawable by check, draft, order, or otherwise. Functions of bank are classified as primary functions and secondary functions. Primary functions are of two types: accepting deposits and granting loans and advances. Deposits can be accepted in the form of savings, fixed, current, and recurring deposit. Savings is to save money timely. Fixed, they have specific tenure. Current deposits, which it is used for businessmen. Recurring deposits for again and again transactions. Granting loans and advances are of four types, like cash credit, bank overdraft, loans, and discounting of bills. Secondary functions are classified as agency functions and utility functions. To transfer funds, collection of checks, periodic payments and collection, portfolio management are all agency functions. Based on the use of the function, like different types of utilities, we have issue of drafts, letter of credit for import and export. To have safety of valuables, we have locker facility, underwriting of shares, dealing in forex, project reports, social welfare programs, and various such functions. Now, depending on the functions of bank, the banks are classified into different types. But before we begin uh, of looking at different types of banks, we must know that for reaching modern day banking business, banking industry has to pass through various types of evolution and development. Let us look at the stages of banking evolution briefly. Looking at the first type of bank, we have indigenous banks. These are nothing but Seth, Shahs, and Shroffs. In the earlier period, these were indigenous bankers. Here, the banking system was not organized. It was normal accepting and lending of money with very high rate of interest, that too working on commission basis, no distinction between long-term and short-term finances. So it led to the origin of opening of presidency banks. Presidency banks are nothing but commercial banks. First bank established was Bank of Hindustan in 1770 by an English agency named Mrs. Alexander and Company. And the first bank, that is Presidency Bank, established in 1806 was Bank of Calcutta, which was later renamed as Bank of Bengal in 1809. Second bank of Presidency was Bank of Bombay in 1840. Then came Bank of Madras or Bank of Chennai as third presidency banks. These presidency banks helped in commercializing transactions, but it neglected rural growth, it neglected maintenance of small sectors, agriculture. And to have the proper growth of small sectors, there came Cooperative Bank in 1889. In cooperative banks, the members are the owners, but the customers are also the owners of the bank. All these three banks were later merged and formed as Imperial Bank in 1929. Now, these presidency banks and its successors acted as quasi-central banks till RBI was formed. Later, RBI was formed as the Central Bank of India, and after independence, on the recommendation of AIRCS, it was implemented that Imperial Bank to be taken over and merged with former state-owned and state associate banks, and the resultant was SBI in 1955. After the SBI, we have development banks, which were mainly developed to meet long-term finance needs of industry, agriculture, and trade. Now, the other types of banks which were early established, they were dealing in accepting and lending finances. But to meet the long-term need, that is especially to look at agriculture, industry, and trade, we need the development banks which will look at the development of three major sectors. But these banks, development banks, overlooked the importance of the project, that is the finance, the borrower, the repayment capacity of the borrower. It failed to meet the aim of 5-year plan due to private control, and all of this misuse of funds led to the nationalization of banks. Nationalization was a very important step in the economy so that the banks which were under private sector were later transferred to the public sector so that government can have control of it. Firstly, 14 banks were nationalized in 1969 and then 6 more banks were nationalized in 1980. So, with the major segment of banking coming under the control of government, again the rural areas were left unbanked because there was no facility reaching in the rural areas. Nationalized banks worked at the apex level. So, to meet the very small needs of the very small people, artisans, and very small businessmen, there needed to be a specialized bank for those people. So, to have the facilities in the rural areas which were left unbanked, there came Regional Rural Bank in the year 1975. Later on, it was a stage of expansion and then consolidation. After that came private banks. Private banks provided personalized services. It provided more flexibility, accountability to the shareholders, integration of domestic financial system with global one, consultancy, advisory, retail housing, and such personalized services were provided. After that came universal banks. Now private banks looked into the personalized services. Other banks were dealing at the commercial level, but there was no bank which was dealing in the forex transactions. That is a single bank which can look at all these sectors. So there came a universal bank. It is a bank that offers retail, wholesale, investment banking services under one roof. Need for banks that can regulate the foreign currency transactions and enhance the market for the same was met by the universal banks. After that came specialized banks. Specialized banks came as a controller for import and export for short-term and long-term finance was Exim Bank in the year 1982. Following it, there was an establishment of NABARD in the year 1984 and SIDBI in the year 1990. So, these were the types of banks which were evolved as per the need of the banking system and the need of the economic development. But today, the banks are classified by RBI as RBI is the regulator of the finance. So it classifies banks into the category of two, that is scheduled banks and non-scheduled banks. Scheduled banks are further classified as commercial banks and cooperative banks. Indian banks and foreign banks form the type of commercial banks. Indian banks are classified as private banks, public banks, RRBs, development banks, small finance banks, and payment banks. Cooperative banks are classified into two, urban and primary and rural. Urban or primary is one and the same, and rural cooperative bank is further segmented into short term and long term. Short term has its three more types, that is state cooperative short term rural cooperative bank, primary agriculture credit society, then district central rural cooperative bank. Long term is divided into two, that is SCRDBs and CCRDBs. Looking to the non-scheduled type, we have LABs, that is local area banks, and non-scheduled cooperative banks. SCRDBs and CCRDBs are nothing but state primary cooperative agricultural and rural development banks. Briefly, this is how the types of banks are classified in India. Looking into detail, firstly, we'll see scheduled banks and non-scheduled banks. So, scheduled banks are the banks which come under the second schedule of RBI Act 1934 with a paid up capital of rupees 25 lakhs or more. Whereas in non-scheduled banks, there is no such rules and regulation of RBI. Scheduled banks have to submit the returns periodically, whereas non-scheduled banks have no such provision as they are maintained with themselves. Scheduled banks are maintained with RBI so they can follow the RBI's rules and regulations. They can be a member of clearinghouse. They can borrow money from RBI, whereas non-scheduled banks are not allowed to do so. It is risky to invest in non-scheduled banks rather than scheduled banks, as scheduled banks can avail repo operations, whereas non-scheduled banks cannot avail the repurchase agreement facility and small loan facility which is provided by RBI. Moving ahead, we have private banks, public banks, and RRBs. Private banks are nothing but banks with minimum capital of 1000 crores. The main function of private bank is to provide services to high net worth individuals, which consist of wealth management, acceptance of deposits and payments, discretionary asset management, tax advisory, brokerage, and lending loans. Public banks consist of minimum capital of rupees 50,000 crore to 60,000 crore. The main functions of public bank are collect deposits from public at lower rates, receives interest on loans and advances at higher rates, lends deposit for the development of agriculture, industries, trade and commerce. It helps in the export promotion, substitution of import, to have a check on concentration on economic, income and wealth, industrial and infrastructure development. The RRBs consist of contribution of capital from three hands, that is center, state and sponsor. All this contribute proportionally in the proportion as stated 50 is to 15 is to 35. That is 50% by the center, 15 by the state and 35 by the sponsor banks. It helps in the disbursement of wages of Manrega workers. It provides basic banking financial services to the rural and semi-urban areas, pension disbursement, parabanking facilities, and development of agriculture, trade, industry. As we have earlier discussed, the importance of those banks, we know the functions here. Moving ahead, we'll see the difference between commercial bank and cooperative bank. Commercial bank is formed under the BRA Act 1949, whereas cooperative bank is formed under BRA Act 1949 plus Cooperative Societies Act 1912. It has to follow both this. Commercial bank functions for credit creation, provision of loan, lending funds, accepting deposits, transfer of funds, agency functions, whereas cooperative banks functions to promote overall development of rural areas. Here the concentration is on rural areas, whereas commercial banks functions for the state level. It looks for the overall development of a state, whereas cooperative banks look majorly to the remote areas and rural areas. It provides financial support to small scale industries, agriculture, rural activities, housing financial assistance, and personal services to small scale industries, and basic banking services to its members. Moving ahead, we have Development Bank, Small Finance Bank, and Payments Bank. Development Bank functions to promote and develop small scale and large scale industries both. Here, it helps in the financing of housing sector. It aids in agriculture, infrastructure, and rural development. Thus, it encourages entrepreneurship and balanced growth. Whereas a small finance bank is a type of niche bank with a minimum paid up capital of rupees 200 crore. It provides financial inclusion to business units. Small finance banks work in the small corners of the economy to help develop those niche areas. Our niche areas are our small and marginal farmers, MSMEs, and various such unorganized sectors. So it undertakes basic banking activities to serve all these unserved sections. Moving further, we have Payments Bank. Payment banks require a minimum paid up capital of rupees 100 crore, and the first 5 years of the start of business, even the promoter must contribute at least 40% of payment paid up capital along with the minimum paid up capital of rupees 100 crore. It ensures financial inclusion by providing financial remittance services to the migrant labor workforce. It helps in the opening up of small saving accounts of small business holders and household. It basically provides the payment facility. Small finance bank works in the niche areas and the development banks work for both small scale and large scale industries. Next we have foreign banks. Foreign banks are those banks which are incorporated outside India and must maintain paid up plus reserves of rupees 15 lakhs. But if the bank is established in Mumbai or Calcutta, if it has opening either in Mumbai and Calcutta or at both the places, then the paid up capital plus reserve must comprise of rupees 20 lakhs. It brings more sophisticated financial services in the economy. It helps in nursing weak banks back to health. It results in the transfer of skill, technology, and currency. It helps to expand financial intermediaries, markets, and reduction in solvency risk. Foreign banks are must in an economy for its overall economic development. Next non-scheduled bank is local area bank. It is a bank with minimum paid-up capital of rupees 5 crore. Now, since the name suggests local area banks, it provides loans to local customers for agriculture and its allied activities. It is a bank at very low levels. It strengthens the institutional credit function in rural and semi-urban areas. So these were the types of banks. Now there's a question for you all. Please do leave answers in the comment section. The very first question is, business of banking has been reported its origin from dash period, and which type of bank requires a minimum paid up capital of rupees 25 lakhs. Stay tuned for more such videos.